Here are 10 ways to buy rental properties with less than 20% down. First up, we have owner-occupied loans. These are loans like FHA loans, 203k loans, VA loans, conventional loans. They're loans that allow you to buy a property, live in them for at least 1 year, and then you can move out. The reasons why you'd want to use them are you have lower down payment options like FHA 3.5, conventional is 3, USDA is 0, VA is 0. These low down payments and loan options would not exist if you did not move into the property at first. They also offer lower fixed interest rates, which are great if you're trying to buy an investment property. And it can give you a place to live for a year while you're learning about real estate, saving money on rent, and instead spending it towards a mortgage. But why wouldn't you want to use these loan options? What are some cons about them? You have to live in the property, and so that might be a lifestyle choice of yours that you don't want to live where you're investing. In year one, while you're living there, it's going to be hard to get cash flow. You might be able to save money on rent, but it's not going to be really something you're going to make a positive cash flow in most cases. Third is that if you leverage too much, meaning you have such a high loan amount, it's also going to be harder to cash flow because of that as well. And last, when you put less than 20% down, you usually deal with mortgage insurance premiums or private mortgage insurance, which is an extra cost every single month just because you put less than 20% down. The general requirements are that you don't have a terrible credit score. So with FHA, you can put 10% down with a 500, and with a 580, you can put 3.5% down. But as always, you want higher credit in order to get better loans. You're also going to need a stable job for the last 2 years for most of these loans, and you need the savings to cover your down payment and closing costs, with also having a debt to income ratio that's lower than what the standard is for each loan. Each one is going to be a little bit different. And the way this process works is you basically buy a house, live in it for a year, and while you're there, maybe you fix things up. You rent out other bedrooms, or you rent out other units if you get a duplex, quadplex, or triplex, and then you move out, you go into another property, and then you rent this first one out in full. The second option is using a hard money loan, then refinancing to keep the house long term. So a hard money loan is a low down payment, high interest, short-term loan that people use for rehab. And so you can get some loans as low as 7.5% down to 20% down. They close quickly. They'll give you the money for the rehab. So basically the way it works is you get some work done, you pay the contractor usually, and then you show the bank, you say, hey, I paid the contractor, and they'll pay you back by doing an inspection and a draw request. The other good part about this is they'll actually analyze the property with you to verify that it's actually going to be a good investment. And fourth is that there's no job needed for these types of loans. You can be a full-time real estate investor and get these loans over and over and over again without being limited by how much money you make. Few cons of using these loans is that they typically have high interest and a large origination fee. An origination fee is a cost based off of a loan amount that you have times a percentage. So usually it's somewhere between 2 and 3% of the loan amount. On every $100,000 of the loan amount, that's $2,000 to $3,000 in upfront cost. Another thing is that sometimes these banks have higher requirements for you. So if you have experience, it's going to be better for you than if you don't. You can make a really costly mistake with these if you have high interest and you don't fix the property. So here's how it would work if you're trying to do this method. You first need to find a property that meets this formula. The offer price equals 0.7 times the after repair value. Then you subtract the rehab cost, the holding cost, and closing costs. So for example, if we find a house that after it's fixed up will be worth $200K, and it'll cost us about $20,000 to hold it, $20,000 in closing costs, and $40,000 in rehab, then we need to buy it for $80,000 in order for it to work. Once you find a property that meets those requirements, you call the lender up and ask them to get pre-approved. Place an offer. If it gets accepted, you start doing the work. As you do the work, you do these draw requests where if it's a large rehab budget, maybe you spend $10,000 and then you get refunded, $10,000, you get refunded again. Then once it's done being fixed up, you get tenants. After a 6-month period, sometimes a little bit shorter, you refinance with a DSCR loan, a debt service coverage ratio loan, which looks at the rent divided by the principal, interest, taxes, insurance, and HOA fees on the property. If that ratio meets a certain percentage, usually it's about a ratio of 1.25, then they'll give you a loan on the house if you have good credit and you have an LLC for it. That whole strategy is known as the BRRRR strategy. We've done videos on that, but this is kind of the whole method on how you be able to buy a property using a hard money loan. The third option is partnering with a friend or family member and you do the work. This could be great because it could help you overcome your ability of not having cash, your ability to get financing. Maybe you don't have the experience needed, or maybe you don't have the income needed to get a loan. And so it can allow you to get more properties quicker. There's a few reasons why you wouldn't want to use this. First, you might have personality conflicts. Like you're two hard-headed people, you won't be able to work together. This usually works really well when you have one person who's more passive and one person who's more active and makes decisions. Or when you have two people that complement each other in the sense that one person's good at fixing things up, the other person's good at managing people, and so you end up working well together. One person's good at analyzing deals, the other person's good at going out and talking to people. Those are two different skill sets that are good when you're partnering together. Another thing with partnerships is that you're gonna have to compromise on everything. When I have a deal, because I have partners for almost every business I'm in, I have to call the partners and see if they're okay with it. I can't just make decisions decisions based on my own. My social media business though, I can make decisions on my own because it's just me. You're also splitting the profits. So when you split the profits, you're going to make less money on each deal, and that's okay. You might have to pass up certain deals because you're just not going to make enough to do it. You're also legally responsible for another person's actions in your company because you're also someone in the company. So you really need to make sure that the person you're working with is someone that you trust and someone that you are hoping to do things long-term with. And also it makes your taxes a little bit more complicated based on how you file your partnerships. But basically the way it works is you need to figure out what your value add is. Is it knowledge, money, time, ability to get financing, or experience? Whichever ones you have, you need to look for someone who has the opposite, the missing one. So you're going to start by telling everyone what you're doing. I do this on social media. So sometimes people come to me. When you're doing this to start, you're going to want to tell your friends and family what you're doing. You'll notice that some people are interested, some people are not. The ones that are interested, don't ask them for money, ask them for what they're looking for if they were to do a partnership. If they're interested, schedule a separate time to talk to them about what it would look like to partner with you and how you can provide value to them and they can provide value to you. Set the expectations up front in writing. Have an operating agreement ready to go on how you're going to operate with them, who's going to make what decisions, who's going to be in charge of what, who's going to be providing value in which ways. Then look for an amazing deal, show it to the right person that you're hoping would help meet their goals. Speak to a lawyer and CPA to make sure you have everything set up properly. Buy the home and then make some money. The fourth way is known as crowdfunding a deal. This is when you partner with a lot more people using an online platform through your network or your audience if you're on social media. So again, this is just like partnerships. It's very beneficial because you can have a lot of people that pull money together and you can buy properties a lot quicker, but you end up splitting the profit. So the pros and cons are basically the same, except you have more people in the pot usually than a partnership, which is usually between like 2, 3, or 4 people maybe, whereas might be between 10, 20, 30 people. So how it works is you're first going to find a deal and get it under contract. Put it up on one of these platforms. You have to decide on the structure that you're going to use, whether it's a joint venture, 506C or 506B. Promote it to get people to it according to the SEC guidelines. Definitely look into this a little bit deeper. Then you're going to close on it, do the work, rent it, and split the profits. Way number 5 is to use 0% credit cards to fix up a property, refinance, and keep it. So there's these credit cards out there that have 0% funds for the first 12 months of the credit card. And the way it works is you can pull money off the cards, spend about 3% for processing fees up front. So if you took $100,000 out, you paid $3,000 to credit card companies, but then you'd have $97,000 in cash that you can use to buy property. You typically need a business with at least a 700 personal credit for this to work. But again, when you find a property, it needs to make sure that it meets the formula that we talked about earlier in the second option for hard money loans. Follow those exact steps and you can use that. Instead of paying off the hard money loan to start, you pay off the credit cards and then you go back and repeat the process again. Now, if you enjoy what I'm teaching you here, I have a full in-depth course with over 50 plus videos on how to buy your first rental property step by step. Check the description in the comments for a link to that. It's absolutely free. 6 is seller financing. I haven't been able to pull this off yet, but seller financing is when the seller of the house gives you a loan for the house instead of a bank or a mortgage broker giving you a loan for the house. The reason why you might want to do this is because it's easier to get financing from a person than it is for you to get it from a bank. The person will have flexibility on down payments, no job history, credit checks. Things are all going to be flexible and negotiable. The other thing is that sometimes you'll find properties that are in such bad shape that a normal bank will not give you a loan on it. So seller financing is the only way that the seller can get rid of it, and so they'll get rid of it that way. There's a few things you need to watch out for though. This can trigger the due on sale clause if the house has a mortgage. So you're going to want to stay away from houses that have mortgages. Second is you're going to have a higher interest rate typically. To convince someone to do this, they need to make more money than they could at a bank. And so you're going to eat some of your cash flow to get some of these seller financing deals. And last, it's harder to find people who are trying to do this. And then once you find them, you also have to convince them to do this. But you have to think about this from why a seller would want to do this to begin with. When you sell a house, you take a large sum of money in and you have to pay taxes on that. Instead, you can split your tax hit up by taking mortgage payments. So instead of making $100,000 from a house, if you made $100,000 over 10 years or $125,000 over 10 years, you don't have to pay nearly as much in taxes every year. And it opens up the door for more people to be able to buy the property that they couldn't before if they're open to doing this option. So you need to ask the real estate agent to put an offer in using seller financing, or ask the seller directly when you're speaking to them. You can look for keywords on listings online that say OWC, which means owner will carry, or seller financing, or flexible terms and motivated. Those are some keywords that might trigger people to think that it might be able to be done for seller financing. And last, you can use websites like PropStream to look for houses that have no mortgage on them to target them for people who you're going to try to get to buy that property. The 7th way is private lenders. Now, private lenders are very similar to hard money lenders, except they're like people that have money, whereas hard money lenders, I would call, are companies that offer loans. The people can be a little bit more flexible. And so there's, again, no minimum down payments. There's typically no minimum credit. They'll be flexible. You don't need a job. You can close with cash on a lot of these properties. And typically what you do is the same thing with the hard money loan. You use the private loan to fix up the property, and instead you end up refinancing it to a 30-year loan, or you end up selling it and taking the cash that way. The eighth way is using a cash out refinance or home equity line of credit. A cash out refinance is when you take a loan out on a house that you already own and pull the equity out. To use that, you refinance your rate, meaning your rate will go up or down based off of where the market is right now. Most people will probably go up, and then you use that to go out and put down payments on other properties. The other thing with home equity lines of credit is that they're typically variable rates. So if you think rates are going up, then you will end up paying more money on a HELOC versus the cash out refinance, which will be fixed. And so there's a formula to figure out how much equity you might have in the property. Equity is just what the property would sell for today minus any loans you have on the property. And so if you think you have a property that's worth $205,000, but you have $145,000 in loans, that means you have $60,000 in equity in that property. That's great. But banks use something known as LTV, or loan to value, to figure out how much they will give you in this cash out refinance or HELOC. Most banks will give you somewhere between 70 and 75%. So they'll look at what you currently have and cap it at total of 75%. So in this case, if I have a loan of 145 and my house is worth 205, then I currently have a loan to value of 70.7%. And so let's say, for the sake of example, that this bank will allow me to take up to 80% LTV, which means I have to leave 20% equity in the property to make the bank feel safe. That means I can take 80 minus 70.7 because that's what my current loan is now. So that means I could take up to 9.3% in equity in my property out through a cash out refinance or through a HELOC. So I would take $205,000 and multiply that by 0.093. That means I could take $19,065 out of my property to use that as a down payment on another property. The key thing here is that you need to make sure this new debt that you take on, this new $19,000 worth of debt, is paid for by the cash flow of the current property or the new properties that you buy. It can't just be new debt that costs more, otherwise you now have liabilities instead of assets. So the way it works is either own a house or partner with someone who does. Call a bank and say you want to get a loan. Show the docs, get the house approved, you get the loan, and then you use that to buy your next property. Number 9, borrowing money from a 401k to buy your house. This is going to be very similar again to the hard money loan. There's these things called hardship loans that you can take on your 401k. So if you have a 401k, you can do this. You could take up to $50,000 or 50%, whichever's less. You use that for down payment funds or rehab funds on a property. You fix it up, you either sell it to get the money out or you refinance. You take that money to pay back off the loan. You typically have to pay it back within 5 years plus interest for borrowing the money against your 401k. And you can't leave your job within a 60 to 90 day period. Otherwise, you will need to pay the whole thing back in full or be taxed with an early withdrawal on your 401k. And you're going to pay a little fee to take the money out, like $50 to $100. And the last thing is taking a securities-backed line of credit or loan. Again, very similar to how hard money loans work. If you have securities, things like stocks, you can borrow against that in a portfolio. A friend was telling me how he borrowed 50 to 70% of the portfolio. So if he had $100,000 in stocks, he was able to borrow $50,000 to $70,000 all at once, pull the money out, and then use that to buy a property. Now he pays interest on that, but it's money that he can use to put as your down payment on a property, get the property, get a mortgage for it, fix it up, and refinance it to pay it off. Then you pay off the SB lock and you bought the property, all without using any money out of your pocket. Subscribe if you enjoyed this video.